Well, investors are awaiting earnings reports from U.S. companies totaling $20 trillion in combined market cap. So what are the biggest headwinds and tailwinds to watch for this earnings cycle? Joining us to discuss, Jack Manley, JPMorgan Asset Management Global Market Strategist. Jack, great to have you in studio. Thanks for being here. So the market action right now, to what extent do you feel it's going to be driven by earnings in lieu of trade negotiations, given that we are not getting those headlines at this time?
Earnings are always going to be important, especially for long-term market prospects. But as Josh just mentioned, right, so much of what's going on right now will likely only be realized several months down the line. The numbers right now from an earnings perspective seem to be shaping up pretty good. I mean, pretty well. They're actually looking better than they did at the start of the quarter, at least for a year-over-year growth, from a year-over-year growth perspective. What I'm very curious about is forward guidance, particularly from those quote-unquote Magnificent Seven. When we do look at the market, Josh again mentioned this earlier. So much of the sell-off has been driven by this very small handful of names that, in turn, did most of the heavy lifting in 2024 and 2023. And the valuations that you saw in those names made them extremely susceptible to shocks like the ones that we are seeing right now. And when you think about a handful of those Magnificent Seven names, right, we think about some of the smartphone manufacturers, for example. Think about how many smartphones these companies sell to China, and think about how many of these smartphones are made in China, right? There are sort of two different exposures to regions that are being, that are sort of in the crosshairs, I guess I'd say, for tariffs that make the Magnificent Seven particularly vulnerable, right? So that forward guidance, I think, is going to be just extremely important right now, and frankly, I think a lot of businesses don't really know what to expect in the near term, which is a little bit concerning.
So with that in mind, how will that forward guidance really kind of cater more to the prevailing thought around fundamentals that we were discussing versus some of the severe feelings that are rattling around in markets right now, which is something that certainly has been playing out even within some of the pullbacks, but yet earnings coming through. And we're still seeing, I think, what FactSet had looked at in continued quarterly growth in earnings profit, at least at this juncture. Yeah,
I mean, we have to remember that at some point sentiment becomes reality, right? If sentiment sticks around for long enough, it will sort of beget whatever it is that you are concerned about. The question, I think, is how long it takes to get to that point, and do we get a little bit more clarity on policy before we hit that sort of tipping point? And I guess I could say I'm crossing my fingers and saying I hope so, but
we all are.
Yeah, I mean, we're all crossing our fingers, but I don't actually know. The fundamentals right now, to your point, Brad, are looking pretty solid, and the story that I'm looking at right now is not necessarily these specific numbers, but the relationship, to bring it back to the Mag 7, between the Magnificent Seven and what I like to refer to as the S&P 493. It's that 500 name index minus the Mag 7, and how they are performing relative to one another. The S&P 500 down maybe roughly 10% or so year to date. I don't remember what the exact number is. The Mag 7 is down double that. The rest of the market's not really down much at all. And when you look over to what's going on in the earnings side of things, analysts at the moment are calling not just for the worst year, quote unquote, for Mag 7 earnings since 2022. They're also calling for the best year for the S&P 493's earnings over that same time period. And so that proximity to earnings parity, the fact that earnings growth is set to look more or less the same for both of these components of the market, that's what I think is a lot more interesting than the specific numbers themselves. So I expect to see these numbers get whittled down. There is so much uncertainty. Confidence is not particularly good, but where the whittling actually happens is going to matter a whole lot. And as long as this dynamic of positive earnings growth across all components of the market plays out, then I think we still have a pretty wide opportunity set as equity investors.
So what do you do with the thesis that you just laid out as an investor? Do you buy more Mag 7? Do you hedge against it with the other 493?
Yeah, I mean, the gazillion-dollar question, what do you do about all this stuff? Admittedly, very difficult. The way that I've been thinking about it is, if indeed we are fishing in this much bigger pond, right? It's not just 7 names, it's a whole 500 name index if you limit yourself to the S&P 500, which for what it's worth, I think is what you should be doing. I'm not much of a small cap guy right now. I think there is a big temptation, Madison, to your point, to cut out the Mag 7. I would not do that. I mean, we are still looking at positive earnings per share growth for the Mag 7 this year. These companies are not companies that got cooked up in some guy's garage a couple of weeks ago, right? These are long-standing companies with enormous balance sheets, proven track records of innovation. You do not want to be shorting these names at all, not to mention the fact that tech is a long-term secular trend. So it's not about carving out the Mag 7. It's not even about pitting value versus growth, which is another thing that I hear a lot right now. Surely this must be a more value-oriented market, but when you are talking about 493 names that haven't really done much of anything over the last 2.5 years, they're going to be growth names in those 493 and value names in those 493. So it's not a style box play either. We're always big proponents of security selection, of active management, and good active management always seems to be worth the price of admission. But I think at this very moment, given where valuations are, given where sentiment is, given how uncertain macro conditions are, policy is, what's going to happen with interest rates, this is all about security selection. It's all about finding those winners and those losers, which means that it's all about active management. That's how you got to approach this market right now.
Jack, just lastly while we have you here, I got about 30 seconds. How is your team at JPMorgan speaking about and talking about the factoring in of a Trump put and a Fed put and the combination of those two factors?
Yeah, well, I mean, these are things that, at least on the Fed side of things, can never be explicitly discussed. Like, It wasn't too long ago that Powell gave that speech, and somebody asked, is there a Fed put? And he said no. I mean, like, what is he supposed to say? Yes? Like, he can't say yes, of course. There's
it's not part of his mandate.
Yeah, it's not. I mean, he can't say, I'm going to step in and save everything all the time, no matter what. I think you have to read between the lines here. And I think if you look at that summary of economic projections from a few weeks ago, the dot plot that came out as part of that March update, the Fed very clearly demonstrated that it is biased toward cutting, even if we head into something of a stagflationary environment. And so I do think that is something that we can lean on as investors, that look, if the consumer really starts to feel the pinch from tariffs or even uncertainty around policy, that the Fed will step in and likely accommodate at least to some extent.
Jack, great to see you here this morning. Thanks so much for taking the time.
Thank you, guys.
Absolutely.